In a single day, this company lost more than US $200 billion in market value. This is the largest ever single-day drop for a US-listed firm in terms of market capitalization. The company we are talking about is Meta Platforms, formerly known as Facebook. After announcing its 2021 fourth quarter earnings in early February this year, the market was spooked by the company's dismal forecast, blaming Apple's privacy changes and increased competition from the likes of TikTok. However, here at MoneyWiseSmart, we believe that the market grossly misunderstands Meta's overall business and the steep fall in its share price is unwarranted. Right now, let's explore Meta's business and why we think there's an opportunity with this company for investors who have the long term in mind. But before that, do smash the like button and share this video with your friends so that it can benefit many other people just like you have benefited. Meta Platforms, formerly known as Facebook, is a company that may not need much introduction since all of us would have at least used one of its products. The company's mission is to give people the power to build community and bring the world closer together. True to its mission, Meta has a couple of products, and they include Facebook, Instagram, Messenger, and WhatsApp. Meta changed its name in October last year from Facebook to reflect its growing ambitions beyond social media and into the metaverse. The metaverse sounds promising, but we are focusing on Meta's core business in this video. Now, let's look at how Meta makes money. Meta generates almost all of its revenue from advertising, as you can see from this table. The advertising revenue is generated by displaying ad products on Facebook, Instagram, Messenger, and third-party affiliated websites or mobile apps. For the financial year ended 31st December 2021, almost 98% of its total revenue came from advertising. Meta is an extremely profitable business, as can be seen from its growing financial metrics over the last 5 years. For instance, from 2017 to 2021, Meta's revenue grew 30.5% on an annualized basis, while net profit rose 25.4% annually. That's tremendous growth. Meta enjoys a high rate of return on equity of slightly over 30%. This shows that management is doing a great job in growing shareholders' capital. Adjusted free cash flow, after deducting for share-based compensation, rose 21% annually over the past 5 years. The copious amounts of free cash flow generated by Meta has allowed it to buy back its shares. Last year, Meta also repurchased and subsequently retired 136 million shares of its Class A stock worth around US $45 billion. This translates to an average share price of US $329.50. As of 31st December 2021, Meta still has 38.8 US billion available and authorized for repurchases, as you can see from this highlight. Meta's market capitalization stood at around US $550 billion when we first did our research. If the company were to buy back the total amount of its shares allowed for this year and retires them, it would have repurchased around 7% of its market cap. In other words, it also means that if Meta's free cash flow stays stagnant in 2022, which is very unlikely, its free cash flow per share would still have increased by 7.5% due to the decreasing share count. Overall, with a growing return on equity, a rock-solid balance sheet with loads of cash and zero debt, and excellent capital allocation, Meta could continue generating tremendous value for shareholders. Growth prospects. In the short term, Meta's growth could slow, and that spooked the market after the company's 2021 fourth quarter financial results were released. Another reason why its share price crashed. During the latest period, Meta experienced a slight decline on a quarter-on-quarter basis in the total number of daily active users or DAUs on Facebook. It also saw a slight decrease on a quarter-over-quarter basis in the number of DAUs on Facebook in the US and Canada region, as you can see from this chart. However, we believe that even if Meta's overall user base stays stagnant, advertising revenue would still grow at a decent clip. The overall growth in the global digital marketing space should also benefit Meta over the long run. Global digital marketing expenditure is expected to grow from US $380 billion in 2020, which is around 59% of total market media ad spend, to US $785.1 billion in 2025, which translates to 72% of total media ad spend. Overall, the growth from 2020 to 2025 translates to a CAGR of around 16%. Moving on, the social media giant has not tapped much into its non-Facebook products such as WhatsApp and Instagram. And that can benefit the company over the long term if it plays its cards well. The largest Facebook and WhatsApp communities in the world are in India, and the company believes there's an especially important opportunity to serve small businesses and enable commerce over there over the long term. Irrespective of which source of data we look at, there's no doubt that there's a very long growth runway ahead considering the population of India. Even a 10% to 15% jump over the next few years in internet penetration in the country has a potential to add 140 million to 200 million new internet users. And Meta is a big beneficiary of that growth. Last but not the least, if Meta continues its share buybacks and is meticulous about its capital allocation plans, shareholders could benefit over the long term as well. Want to know more about Meta? You can find a free preview of the detailed report at the link in the description section below. Do join our free preview to unlock Meta's research and many other companies that have the potential to become multi-baggers of the future. Also, if you learned something from this video, do like and share it and subscribe to our channel for more of such videos. See you next time and happy investing.